Annual inflation for March slowed to a 5-month low of 2.7% from 3.2% in February. That's according to the latest Stats SA figures released earlier. Well, this brings inflation below the SA Reserve Bank's target range of 3 to 6%, potentially paving the way for interest rate adjustments. Well, Liandra Da Silva, specialist economist at Nedbank Group, joins me now to look at the latest data. Thank you for taking the time to chat with us. Good afternoon.
Afternoon. How are you?
I'm great, thank you. What are the primary drivers behind the decline in inflation to 2.7% in March 2025?
So as we've seen, it dipped quite notably following it remaining steady at 3.2% in January and February. So the main downside risks actually came from food and non-alcoholic prices, which came down to 2.7% as well from 2.8%. Utilities a little bit lower, and another factor that contributed was restaurants and hotels also dipped quite a bit. I think it was from 4.2%, 4.6%. So those were the main drivers.
Is this sustainable under the current domestic and economic pressures, Liandra?
So our outlook for inflation was that it would remain within target for most of 2025, and it would end within the 3 to 6% target range at the end of 2025. But there are obviously some upside risks. None of them are really stemming from the domestic side of the economy. Most of the upside risks that we expect, with the exception of electricity tariffs, because often they increase by double digits, which is above inflation for the most part.
Sure.
But outside of that, most of the upside risk that we expected to come through is from what is happening on the global side of things. It has implications for the domestic currency, and if the currency weakens, then import demand, so import inflation could be brought into the fore, which could ultimately drive inflation within the domestic economy higher. So there are significant upside risks, and you did highlight earlier that the SABC is concerned about this. It is actually the main reason why they are unlikely to continue cutting interest rates for the remainder of the year.
Do you think the decline in inflation pace will encourage the Reserve Bank to possibly cut interest rates just a little bit?
So our assumption is no, and this is mainly as a result of the vulnerability of the rand, so the risk to the rand. So the unfortunate thing about being a small open economy and also an emerging market economy is that anything happening on the global side of things is a potential shock, could be a potential shock to the currency or even developments within the domestic economy. So because of the uncertainty that the globe is being faced with as a result of the tariffs, of the concerns about a potential trade war, those are risks to the rand that could ultimately filter through into the domestic economy through what we call import inflation. So that is the main risk. And because there's so much uncertainty around how this will develop, the SARB is likely to take a wait and see approach to things and be cautious before they decide to cut interest rates. They need to sort of understand and see how inflation will be impacted by what's happening globally before they do decide to take a policy decision.
All right, so that's unlikely. Well, what does the divergence between headline CPI 2.7% and the core CPI at 3.7% suggest about the persistence of underlying inflationary pressures in the economy?
So, core inflation, despite it still remaining a little bit above headline, it is still well within the target range. It has been for quite some time. So for us, that provides an indication that the underlying price pressures have actually subsided and eased. 3.1% is literally at the lower bound of the 3 to 6% target range.
Okay.
So there aren't a lot of upside inflationary pressures coming through outside of within the domestic economy. That's ultimately what we see from that core inflation figure.
Liandra, how might the low inflation rates impact consumer spending and economic growth for low-income households reliant on staple goods?
It's a great thing. One of the downside contributors with lower food and non-alcoholic beverages. So that's great. It means that for the most part, the prices of food are remaining relatively stable or even declining. So that's obviously quite beneficial for households. There could be sort of a slight increase because food prices will be coming from a low base, so there might be a slight increase as the year continues, but
Yes.
we still expect it to remain within target overall. So there is a lot of relief coming through for consumers, even better than what a lot of economists had previously expected. So 2.7% is lower than what market was expecting at 3.1% for us, as well as 2.9% on average. So it's a good thing. It means that there's a lot more relief than what we were expecting.
And then lastly, what are the possible risks to South Africa's inflation outlook for the rest of 2025? You've indicated you feel they're probably good, given the global context of fluctuating commodity prices and, of course, rand volatility.
So overall, the outlook is on the upside. There are a few good things happening within the domestic economy, as well as externally. So let me mention some of the downside risks. So what will keep inflation low? So first of all, global oil prices for the most part have remained low. Let me mention that. And the reason for this is that there is an oversupply within the global economy when it comes to crude oil production. Secondly, there is generally weaker global growth. So when there's weaker global growth, there isn't necessarily as much demand for oil prices. So oil prices remain stable because, with increased supply and less demand, prices cannot necessarily increase. And if we think about one of the biggest economies, one of the biggest importers of crude oil, China, growth in China is expected to slow quite notably this year. And if we consider also the implications of the tariffs by the US, that is likely to weigh even more on growth within the Chinese economy, which will probably keep oil prices even more capped. That's one thing. Another
Liandra, I'm so
thing that I
sorry.
wanted to highlight is...
Liandra, I'm so sorry. I'm going to have to cut in there, but thank you so much for your insights. We've run out of time. We've got such a packed bulletin today, but I appreciate your time and, of course, your valuable insights on the latest inflation numbers. That was Liandra Da Silva, specialist economist at Nedbank Group.